Some market reaction to all of this from Earl Davis. He is head of fixed income and money markets at BMO Global Asset Management. Nice to see you.
Good morning.
We've heard from the political pundits and the former politicians, all that stuff. But what do the markets think of this?
Yeah, I think there's two aspects to this. One is the market. It's not a shock to the markets in regards to today. The markets are largely trading unchanged to the U.S. to slightly better. So there wasn't a big market adjustment in the short term. Where I think the biggest risk to the markets is what is the rating agency's response to this? Because if you remember last year's budget, the rating agencies maintained our credit rating, but they said this will be subject to future fiscal, how it unfolds fiscally. So their response could be where the shock comes. So that is yet to be seen in regards to how they respond to this budget.
And their determination on whether they make some kind of change to Canada's credit rating would be what? What would they be keying in on?
Great question. So I have a saying, give someone one less reason to say no. So part of what they were looking at for the no's to at least putting a warning or a signal on the direction of credit ratings is deficits. So the deficit is not decreasing, and there's new spending. So it depends if that falls within their margin or not of comfort for maintaining the credit rating.
And, you know, we talked yesterday about how just like for all Canadians, their debt borrowing costs are going up. Canada's borrowing costs are going up just simply by the fact that rates are higher and has taken on a lot of debt. But I guess based on what you're saying, the cost of servicing that debt could technically be higher if the rating agency was not on board with the fiscal plan.
Yeah, and even if they're not on, even if they are on board, it could still possibly be higher. Why? You just have to issue more debt to fund the spending and incentives. So because it's just a supply demand. So, you know, if you have more supply, what's the interest rate that people want?
Yeah.
I would have to say that fiscally, Canada, from a financing perspective, put themselves in good shape because when rates were low, they extended their maturities in regards to going longer, 10 years, 30-year debt. Now they're decreasing that because they don't want to lock in this level of interest rates. The only caveat I would say to that is that they're putting a lot of, I think they get comfort with the budget and with the direction of the market based upon the Bank of Canada's outlook for inflation and stuff. So there's a lot of risk there still.
I did want to ask you about inflation because the thing I was thinking about was last year we had a crisis play out in the UK where you had a government that wanted to push ahead with some tax cuts, which certainly is not the focus of this federal budget. But there clearly was some inflationary concern with something like that. In this case, we're talking about more spending, and there can be inflationary concerns with that. How would you compare those two situations? And is it maybe just more that the market is less concerned with inflation, a little less antsy about it today than it was previously?
Yeah, and I think there's a very easy way to look at that. Okay. You know, it's your plus and minus. So your minus are your costs, so your spending. And the UK last year announced at the same time as tax cuts a significant increase in spending as well, too, for the middle and lower class. And then it's your plus. What are the revenues you're getting in, you know? And there's three ways to look at your pluses. It's your revenues you're getting in, it's tax hikes, which there are some marginally here, and it's also productivity. Unfortunately, there's nothing in this budget that addresses productivity immediately. Hopefully we get that through the green initiatives and electricity going forward, but that's a longer-term game. So basically, they have increased taxes on the margin, not enough to offset the spending, and then spending has increased, which is different from what the UK did.
Yeah, and productivity. Hey, we could talk all day about Canada's productivity challenges. That's been a long one we've been talking about. You know, the other thing about inflation, and we saw that in this budget, it netted more revenue, at least in the short term, for the government. So that helps the coffers, I suppose. But just speaking about inflation and the economic backdrop, you know, there didn't seem like there was a big focus on some of the banking turmoil. We're going to have more on UBS coming up as part of this budget yesterday. But as someone who's asked about how to position the market right now, how are you feeling about the markets?
Yeah, so I think there's two ways to look at inflation. One I'm concerned about, one I'm not so much. One is your nominal inflation rate, what's your CPI and stuff. And that has been declining, a good trend down towards the 2 to 3% target that the Bank of Canada wants. But the other part is core. And core is concerning to me because it's not declining as much. And core represents inflation expectations being embedded in people. And once you get that, it's easy to pass through costs. And if you look at a lot of the analysts' reports from last year, a lot of the companies did all right because they passed through costs. And people are accepting those costs. So the core number is very key from an inflation perspective to see that start trending down at the same place we're seeing nominal. And that's where I'm concerned about.
And then, Earl, just sort of on bringing it back home to interest rates, because that's the other thing we're trying to figure out right now. You know, there's this view in the market that we could see in the U.S., the Fed, just because of everything going on, pivot on rates this year. Haven't really gotten that message from the central bank itself so far. Where do you weigh in on that? And I would add the Bank of Canada to that. What do you think their rate plans are for the rest of this year?
Yeah, I think there's one thing that's definitely going to happen in the U.S., and it's kind of related to Canada as well. The Fed is not going to hike as much as they would like to, or were discussing even a month ago in regards to the possibility of 50 basis point hikes. That is totally off the table. It's just going to be 25s and possibly a pause. But because of that, because they're going to hike less than they have to, they're going to keep rates higher for longer.
Keep them higher for longer. And then for anyone who's invested in the fixed income market, what is that? Maybe we've heard endless story. We've even heard it through the collapse of Silicon Valley Bank. It does not pay to be in long-term debt right now. So how are you thinking about how to be positioned in fixed income?
Yeah, there's two things. One is this volatility is going to increase or maintain. It's going to stay at these high levels. So be aware of that, right? And because of the rally we've had, because of the banking scare, we don't feel comfortable being longer duration. We still like the very short end. We think there's a lot of risk to higher rates in that 5, 10, 30-year sector. So we're trying to stay away from there or be underweight, stay in the short end. We still like credit short end, 3 years. We especially like Canadian banks now because they widened when the Credit Suisse widened, but we have a much different mandate here. So we really like Canadian banks.
To do that. On the bond side, you mean?
On the bond side in the 3 to 5 year sector.
Yeah. Okay, great.